Welcome back to the deep dive. Today, we're tackling something crucial for pretty much everyone thinking about the future: individual retirement accounts, or IRAs.
That's right.
And we're not just talking definitions. We want to really get into how they work with taxes, especially when you take money out. Because understanding distributions, well, it really starts with understanding how the money goes in.
Exactly. Getting that part right can make a huge difference down the line. It's one of those smart financial moves.
Okay, before we properly dive in, just a quick reminder for everyone listening.
Yeah.
This deep dive is based on material from Farhat lectures. All the content, the examples, the explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com.
Great stuff over there.
Absolutely. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, you should definitely check out the website. They've got more practice questions, video lectures, tons of support to really reinforce what we talk about today. And a big thank you to Professor Farhat for providing this valuable material for us.
Indeed. Thanks, Professor Farhat.
All right, so let's start at square one just for a second. What exactly is an IRA? We hear it all the time.
Yeah, good question. At its heart, it's really just a personal savings account. Simple as that.
Okay.
But it's one set aside specifically by you, the taxpayer, for retirement. That's the key.
And it's individual, right? That's important too. It's not like a 401k from your job.
Precisely. That individual part is critical. And like you said, understanding how money goes and the contributions is, well, it's fundamental to figuring out how it comes out, the distributions, and how those get taxed.
Okay, that's it.
You need the input to understand the output. And basically, we have two main types, two flavors, if you will.
Yeah.
The traditional IRA and the Roth IRA.
Traditional and Roth. Got it.
And comparing them side by side is really useful because the choice you make between them can have really massive tax implications, like decades later.
Okay, let's start with the traditional IRA then. I hear this one offers an upfront tax break. What does that actually mean?
Yeah, that's the main draw for many people. Contributions you make to a traditional IRA might be deductible. Keyword there is might.
Might. Okay, so if it is deductible.
If it is, you get a tax break now in the year you contribute. So let's say you put $5,000 into a traditional IRA, and maybe you're in, say, a 30% tax bracket.
Yeah.
That $5,000 contribution could potentially shave $1,500 right off your tax bill for that year, immediately.
Wow, $1,500 back just like that.
Potentially, yes. And here's the other big plus. While that money sits in the IRA, it grows. Interest, dividends, capital gains, all that growth happens tax-deferred, meaning you don't pay taxes on those earnings year after year. The tax bill is pushed down the road.
Tax-deferred growth. That sounds pretty good.
It is. But going back to that might be deductible point, it's important to realize it's not automatic for everyone. Your ability to deduct really depends on your income level and whether you or your spouse are covered by a retirement plan at work, like a 401k.
Ah, okay. So there are rules around the deduction itself.
Exactly. But for understanding the core concept right now, let's focus on that potential upfront tax break. That's the defining feature.
Okay. So you get the potential break now, the money grows tax-deferred, but taxes always come due eventually, right? So what happens when you actually want to take the money out, say, in retirement?
This is where the other shoe drops, so to speak. There's a golden rule for traditional IRAs.
Uh-oh. Golden rule.
Yeah. If your contribution was deductible when you put the money in,
Okay.
then the entire distribution, when you take it out, and I mean everything, both the original principal you contributed and all the earnings it generated over the years.
Wow.
The whole amount is fully taxable as ordinary income.
Ordinary income rates, not capital gains rates.
Ordinary income rates. Think of it this way. The IRS gave you a break up front,
Sure.
right? They didn't tax the money going in. They didn't tax it while it grew. So they're basically saying, okay, now it's our turn. They collect the tax when it finally comes out.
So the tax bill was just delayed, not eliminated?
Exactly.
Yeah.
Now, what if you made contributions that weren't deductible? Maybe your income was too high or you had a 401k.
Right, that situation you mentioned.
In that case, the portion of your withdrawal that represents your original non-deductible contributions, that's considered a return of capital.
Return of capital, meaning?
Meaning you already paid taxes on that money before you put it in the IRA. So you don't get taxed on it again when you take it back out. It's just getting your own already taxed money back.
Okay, that makes sense. But what about the earnings on those non-deductible contributions?
Good question. The earnings are a different story. Any growth, any earnings that accumulated on those non-deductible contributions, those are taxable when you withdraw them.
So non-deductible principal comes out tax-free, but the earnings on it are taxed. Deductible contributions and all their earnings are taxed.
Got it. It's a bit complex.
It can be, yeah. And there's one more thing with traditional IRAs, RMDs. RMDs.
Required minimum distributions. Generally, once you reach age 72, you have to start taking money out. The government doesn't let you keep deferring the taxes forever.
Ah, so they force you to start taking it out so they can finally tax it.
Pretty much. You generally have to start by April 1st of the year after the year you turn 72. And these distributions, they get reported to you and the IRS on a Form 1099-R.
Form 1099-R.
Okay.
That shows the total withdrawn and how much is taxable.
Exactly. Gross distribution, taxable amount, any federal or state tax withheld.
Mm-hmm.
It's all there.
Okay, theory is one thing. Let's make this concrete. You mentioned Ray's examples from the Farhat material. Let's walk through those. This should really show how it works.
Perfect. Real numbers always help.
So, scenario one. Ray opens a traditional IRA at 55. He puts in $4,500, and crucially, he deducted that full amount on his tax return.
Okay, so you got the upfront tax break.
Right. If he was in a 25% bracket, that deduction saved him, what, $11,125 in taxes that year? 4,500.25. Okay, fast forward 3 years. The account has grown, and Ray takes out the whole thing, which is now $6,200. How much of that $6,200 is taxed?
Well, remember the golden rule.
Yeah.
Since the contribution was deductible.
Ah, the entire $6,200 is taxable.
Bingo. The original $4,500 principal and the $1,700 in earnings, all taxed as ordinary income.
So he saved $1,125 up front, but now faces tax on $6,200 later. It really highlights that trade-off, doesn't it?
It absolutely does. Pay less tax now, pay more tax later, or potentially the other way around, depending on tax rates.
Okay, let's shift gears. Same Ray, same $4,500 contribution. But this time, let's say he couldn't deduct it. Maybe his income was too high.
Okay, a non-deductible contribution.
Right. The account grows, same as before, to $6,200 total value, which includes $1,700 of earnings on top of his $4,500 principal. But this time, Ray only takes out $5,500, not the whole amount.
Okay, a partial withdrawal from an account with non-deductible contributions. This involved that proration rule we touched on.
Proration. Right. So how does that work? You don't just say the first $4,500 out is tax-free principal.
No, unfortunately not for traditional IRAs with mixed deductible, non-deductible funds or just non-deductible funds and earnings. The IRS assumes any withdrawal includes a mix of your non-deductible basis, principal, and taxable earnings, proportionally.
Okay, proportionally, so we need to figure out the ratio.
Exactly. First, what percentage of the total account value did Ray withdraw? He took out $5,500 from a total of $6,200.
Right. $5,500 divided by $6,200. Let me see. That's about 88.7%.
Correct. So the IRS says 88.7% of his withdrawal comes proportionally from the earnings, and 88.7% comes from the principal, since the earnings are what's taxable here.
Ah, so you take the total earnings, $1,700, and multiply by that percentage, 88.7%.
You got it. $1,700 times 0.887, that comes out to roughly $1,508.7. Let's call it $5,508 of the withdrawal is taxable earnings.
Okay, $1,508 is taxable, and the rest of the $5,500 withdrawal.
That remaining amount, roughly $3,992 pounds, $500, $1,508, is considered the return of his non-deductible principal, and that part is tax-free.
Okay, so even with non-deductible contributions, taking money out isn't completely tax-free if there are earnings. You have to do this calculation.
Precisely. It requires careful record keeping of your non-deductible contributions over the years, usually using Form 8606.
Wow, okay. So traditional IRAs offer that potential upfront break, tax deferral, but then you face taxes later, RMDs, and maybe some complex calculations. What about the alternative, the Roth IRA? Why would someone choose that if you don't get the upfront tax break?
The Roth. This is where the equation flips. You're right. Contributions to a Roth IRA are never deductible. You make them with money you've already paid taxes on, post-tax money.
Okay, so no tax savings now, why bother?
Because of the back end. The really significant, incredible benefit of the Roth is this. When you take qualified distributions in retirement.
Qualified distributions.
Yes, we'll define that.
Yeah.
But when you take qualified distributions, everything comes out 100% tax-free.
Everything, including all the growth.
Everything. Principal and all those decades of potential earnings. Completely tax-free income in a retirement. That could be huge.
Okay, qualified distributions. That sounds like the key. What makes a Roth distribution qualified and therefore tax-free?
There are two main hurdles you generally need to clear. First, there's the 5-year rule.
5-year rule?
Yes. You need to have had any Roth IRA open for at least 5 years. The clock starts on January 1st of the year you made your very first contribution to any Roth IRA.
Okay, 5 years from the first contribution. What's the second part?
The second part is also meeting one of several conditions. The most common one is reaching age 59 and a half.
Age 59 and a half. Okay.
But there are others. For example, using the money up to $10,000 lifetime limit for a first-time home purchase, or if you become permanently disabled, or if the distribution is made to your beneficiary after your death.
So meet the 5-year rule and be one of those conditions, like age 59.5, disability, etc.
Correct. Meet both parts, and the withdrawal is qualified, meaning totally tax-free.
And what about RMDs? Do Roths have those required minimum distributions like traditionals?
Nope. Another major difference. Roth IRAs have no RMDs for the original owner.
No RMDs. Why not?
Well, think about it. The government already got its tax money when you made the contribution, right?
Ah, right. Post-tax money went in.
Exactly. So they don't really care if you take it out or not during your lifetime.
Yeah.
You can let it keep growing tax-free potentially for your entire life and pass it on to your heirs, still potentially tax-free depending on the rules for beneficiaries.
Wow. No forced withdrawals. That's a big advantage for flexibility and estate planning.
Huge. And one more key difference in how withdrawals work. The ordering rules.
Ordering rules.
With a Roth, when you take money out, your contributions, the principal you put in, are considered to come out first. Only after you've withdrawn all of your contributions do you start tapping into the earnings.
Contributions out first, then earnings. How does that compare to traditional?
It's different. Remember the traditional non-deductible example? It was pro rata, a mix of principal and earnings. With Roth, it's simpler. Principal first, always tax-free because you already paid tax on it, then earnings, which are tax-free if qualified, taxable if not.
That sounds much better, especially if you need money early. Let's see how this plays out with Ray again. Let's use the Roth examples.
Okay.
First, Roth scenario. Ray opens a Roth at 55, contributes $4,500. Not deductible, of course.
Right. Post-tax.
4 years later, wait,
Mm-hmm.
only 4 years, he takes out $6,000. The account, let's say, has ballooned to $100,000.
Big growth.
Okay, 4 years. Ding, ding, ding. He hasn't met the 5-year rule yet.
Right. So this is a non-qualified distribution, correct?
Correct. Even if he met another condition, like being disabled, he must also meet the 5-year rule for it to be fully qualified.
So he takes out $6,000. How much of that is taxed? Remember the ordering rule?
Ah, yes. Contributions come out first. How much did he contribute?
Just the $4,500 initially. Okay. So the first $4,500 of that $6,000 withdrawal is considered his contribution return. And since Roth contributions are always post-tax.
That $4,500 is tax-free.
Exactly. But he withdrew $6,000. So the remaining $1,500, $6,450, that must be earnings.
And this is a non-qualified distribution?
That $1,500 in earnings is taxable and potentially subject to a penalty, which we should talk about.
Okay, so $1,500 taxed. Still better than the whole amount being prorated, maybe. Now, for the really exciting Roth scenario, let's say Ray waits.
Okay.
He withdraws the entire $100,000 6 years after his first contribution, and by now, he's also over 59 and a half.
6 years. Check, meets the 5-year rule. Over 59 and a half, check, meets the age condition.
So this is a qualified distribution.
Absolutely.
He takes out the full $100,000, original investment $4,500. How much tax does he owe?
This is the magic moment for Roth proponents. He owes zero.
Zero tax on $100,000, even though most of it is growth.
Zero. Zilch, nada. That $95,500 in growth is completely tax-free because it was a qualified distribution from a Roth IRA.
That is genuinely incredible. Pay tax on the $4,500 seed, get the $100,000 harvest tax-free.
That's the power of the Roth when used as intended for long-term qualified savings.
But you mentioned a potential penalty earlier if the withdrawal isn't qualified. What about taking money out too early, say before age 59 and a half? That seems like a common trap.
It absolutely is. It's a major pitfall. The general rule is if you take a distribution from either a traditional or a Roth IRA before you reach age 59 and a half, the taxable portion of that distribution is usually subject to a 10% penalty.
10%, on top of regular income tax.
Yes, that's crucial. It's in addition to any ordinary income tax you owe on the withdrawal.
Ouch. So if that $1,500 in earnings Ray took out early was taxable, he might owe regular income tax on it plus a $150 penalty, 10% of $1,500.
Exactly. It makes early withdrawals significantly more expensive. The IRS really wants you to keep this money saved for retirement.
Okay, that 10% penalty is steep. Are there ways around it?
Exceptions. Thankfully, yes. There are several important exceptions where the 10% penalty does not apply, even if you're under 59 and a half.
Okay, like what?
Well, we mentioned the first-time homebuyer one. Up to $10,000 can be withdrawn penalty-free for that purpose, provided you use the money within 120 days.
120 days. Good to know. What else?
Using the money to pay for medical insurance premiums, but only if you've received unemployment compensation for at least 12 weeks.
Okay, for the unemployed.
Also, withdrawals used to pay for unreimbursed medical expenses that exceed a certain percentage of your adjusted gross income, currently 7.5% of AGI.
So for really high medical bills.
Correct. And distributions made because you are totally and permanently disabled. That's another key exception.
Disability makes sense.
Using the money for qualified higher education expenses, tuition, fees, books for you, your spouse, kids, grandkids.
College costs. Okay.
There's a relatively newer one, too, up to $5,000 per parent per event for qualified birth or adoption expenses, as long as it's taken within 1 year of the birth or adoption.
$5,000 for new parents. That's helpful.
And finally, distributions made to a beneficiary after the account owner's death are not subject to the 10% penalty.
Okay, quite a few exceptions, but you still need to be careful and make sure you qualify.
Absolutely. And documentation is key for proving you meet an exception. And remember, even if the penalty is waived, you still owe income tax on the taxable portion of the distribution, unless it's from a Roth and qualified.
Right. The penalty waiver doesn't make the income non-taxable necessarily.
Exactly. I have a story about this. A couple of friends years ago, they were moving, needed cash, and just liquidated their IRAs. Didn't really think about the taxes.
Oh, no.
Yeah. Months later, they get these letters from the IRS. Huge tax bills. They called me up, totally confused, asking what happened.
And it was the tax plus the penalty.
Yep. I looked at, this is the ordinary income tax on the withdrawal, plus that painful 10% penalty, because they were under 59 and a half and didn't meet any exceptions. They were just blindsided.
Wow. That's a tough lesson.
It really drove home for me how important it is to understand these rules before you touch that money. Being uninformed can be incredibly costly and really derail your financial plans.
That's a powerful reminder. Okay, so let's try to summarize this. We've covered a lot ground on IRA distributions.
We have.
The big picture seems to be this. Traditional IRA, you might get a tax deduction now, your money grows tax deferred, but distributions later are generally fully taxable as ordinary income, and you have RMDs starting at 72.
Correct. Pay tax later.
Roth IRA, no deduction now, contributions are after tax, but the huge benefit is that qualified distributions, including all the earnings, are completely tax-free later, and there are no RMDs for the owner.
Exactly. Pay tax now.
So the choice you make about how you contribute really dictates the tax treatment when you distribute.
Precisely. It's all connected. Your upfront strategy has major consequences down the road. And this really brings up an important question for you listening out there. Which approach makes more sense for you? Considering your current income, your expected income in retirement, your tolerance for taxes now versus later. Which strategy, traditional or Roth, aligns better with your personal financial goals?
That's the key question, isn't it? There's no single right answer for everyone.
Not at all. Understanding these rules isn't just about passing an exam or knowing trivia. It's about making informed decisions for your own future, avoiding those nasty surprises like my friends experienced, and really maximizing your long-term wealth.
Well said. It gives you control. So maybe the thought to leave everyone with is, which IRA strategy, traditional or Roth, feels like the better fit for your long-term vision? And maybe more importantly, what steps can you take now to make sure you're making the most informed choices possible for your retirement?
Good questions to ponder.
Definitely something to think about. And remember, if you want to dig deeper, get more examples, practice questions, video lectures on IRAs, or any other accounting topic, head over to farhatlectures.com.
Highly recommended.
Our sincere thanks again to Professor Farhat for providing the excellent material that fueled our deep dive today. And thank you for joining us.